Good evening, everyone, and or I would like to welcome all the dear participants into this webinar. And before I get started with the webinar, I'd like to say that this is a recorded session, as you could see, and this recording can be availed to you. So we will be sharing a Google form at the end where if you wish to avail the recording, then in that case, you can get it using, giving your details therein. So once again, welcome, dear learners, to the webinar Investment Insights, Market Trends and Predictions 2025. And I would like to take this opportunity to welcome Dr. Sadaf Hashmi. She's an experienced associate professor in finance with over 17 years in academia and corporate training. Holding a doctorate in finance, she specializes in banking and fintech with a strong focus on financial innovation, AI in finance, and financial innovation. She is an empaneled BFSI trainer with NSE and has worked with top corporates like Tata, IAA, HDFC Mutual Funds, and First Branch. So continuing, Dr. Siddharth also designs curriculum for edtech platforms and guides the entrepreneurs on fundraising and evaluation. So welcome, Dr. Siddharth, and also dear learners.
Thank you so much, Reenu, for the warm welcome. I would also request the host to kindly provide me the sharing rights that I can share the presentation for this session. And welcome all of you to this session on investment insights and market trends and predictions for the year 2025. And I know that this is something as a topic which will really interest and intrigue all of you, as we all know the kind of situation that is existing at the international level and the kind of uncertainty which is there, which is influencing our life, our businesses every now and then. And we can see that this is a phase where there is something new coming up every single day. From the desk of Donald Trump, we have seen that tariffs have been shooting right from, say, a 20% to even a 500%, and that is impacting not just businesses but also countries at a global level. And secondly, we have seen the geopolitical issues between different countries, and I think last night was the latest one between Thailand and Cambodia coming head to head to each other. So I think the geopolitical issues don't seem to get any better, although there have been a lot of initiatives which have been taken to reduce various geopolitical issues, but that has not happened at this point in time. So in today's session, we are going to discuss that how and what are the investment insights that we need to focus on, we need to look at, and majorly we are going to look at that what are the market trends. Okay, so I'm just going to share with you the presentation and we're going to have lots of discussion out here. So let's get started. So first, let's look at what the global scenario is right now and what are the kind of factors which impact the financial market. One, the most dominant factor, which has been in discussion since 2022, in fact, precisely mentioning it, February 2022, once the Russia-Ukraine war started, was the fear of inflation. We have seen that across the globe, there is inflation which has been coming in because whenever there are geopolitical issues between countries, there is one commodity which definitely gets impacted, and that is crude oil. So, also, we know that Russia is one of the major exporters of crude oil and natural gas across the globe. And thereby, because of the war between these countries and the European nations standing against Russia, this led to a lot of tensions with the crude oil and the natural gas exports. This brought about the inflation. And with the inflation coming in, the central banks across the world have only one way to control this rising inflation is by simultaneously increasing the interest rates. Now, can you tell me that when the interest rates in any country increases, the borrowing cost goes up or down? Can you write in the chat box up or down? Okay, again, I'm repeating my question. When the interest rate increases, okay, uh, the borrowing cost goes up or down. Can you just write in the chat box? The borrowing cost goes up or down. Everyone can access the chat box, I believe. Will go up. Okay, the borrowing cost is going to increase. And when borrowing increases, it impacts nations, it impacts borrowers in a very big way. The question was, I was asking that when interest rates are increased, does the borrowing cost go up or down? So if the central banks across the world are increasing the interest rate, definitely the borrowing becomes expensive. People will have to pay a higher cost, like a higher monthly EMI, because of which their tenure for the loan can even stretch longer. And in US, this is exactly what happened, that some of the loans which were borrowed by the parents are now flowing down to the next generation as well, because they are not able to pay up the entire amount of loan. Okay, so the borrowing cost increases, and then it can become a big burden whenever you have people taking a home loan, an education loan, a car loan. It could stretch for years and years together. Okay, even for businesses, increase in the borrowing cost is again a major disadvantage, because if any kind of money is required for the day-to-day operations, for the working capital, that money will be available at a major cost. Okay, so to combat inflation, a very simple tool that is used across the world is to increase interest rates. But as we know, that any kind of increase in interest rates will only be a roadblock to any nation's growth, will only become an obstacle to nation's growth. So this was the first thing which started coming in 2022 post Russia Ukraine war, and it has still continued. In fact, for the US market, Donald Trump has been pressurizing the Federal Reserve Chairman, Mr. Jerome Powell, to cut down on the interest rates to improve the liquidity. But in fact, Donald Trump's own strategy of imposing tariffs has backfired the US market. Because if we are imposing tariffs on any country's exports into US, the price is going to increase. It's going to bring inflation. And if inflation comes in, the Federal Reserve, the central bank of US, cannot reduce the interest rates. Okay, so these are the kind of tensions and issues globally that we are seeing right now, which is certainly impacting the financial market. Also, what happens is when the borrowing cost increases and people are focused on paying their credit card EMIs, or their loan EMIs, or their home loan EMIs, they cannot think about investing in the market. They do not have money rather to invest in the market, and even the financial market takes a beating. Companies cannot borrow loans, companies cannot take loans for growth, and again it impacts the corporate growth in a country. Okay, so eventually these measures, as I said, will have a very deep impact in the long run. If the interest rates continue to be high, if the inflation continues to be high, then it will have a very deep impact on the financial markets as well. Now, moving on to the fact about currencies, and we have known that dollar has been the currency, the international currency of the world. But now there is a saga of de-dollarization, and again, US cannot afford this kind of a thing. But we are seeing that how different countries are coming together. They are ensuring that they put up a common currency, like the BRICS nations: Brazil, Russia, India, China, and South Africa. They have decided to launch their own common currency for the purpose of trade, called as SUR, SUR. Okay, and Donald Trump has, of course, threatened the BRIC nations as well. But this is what is the agenda. And if more and more countries start trading in their respective currencies and they start abandoning the dollar, then what is going to happen is that there is going to be no demand for the dollar, and that is going to be a massive setback for the US markets and the US economy. Okay, so emerging markets are focusing on having free trade agreements. Just 2 days back, there was a free trade agreement which was signed between India and UK. Okay, so a lot of Indian exports would be going at lower cost, lower trade barriers into the UK market, and likewise, even UK services, educational facilities will be brought down into the Indian market. So, this kind of an exchange between different countries across the world is really going to paralyze US economy. Okay. So one is de-dollarization and the other one is other emerging stronger currencies across the world. Also, with the geopolitical issues, we are not just seeing trade getting impacted, but we are also seeing a lot of damage to the human life happening. In fact, there was this headline which came in which stated that in Gaza, almost 2 years of education was lost, okay, because of this war which was happening, and things could happen even in Ukraine. So the human capital is also getting damaged because of this. Of course, we are losing human life. That goes without saying in any of these wars or these kind of skirmishes. But also the other people who are surviving, they are obviously not able to lead a human life, and that is impacting their well-being. That is damaging the human capital. Okay, the intellect will not build up as a country, as a nation. So, right now, in a nutshell, this is what conflicts are all about, which are having a deep impact on the market. As we progress deeper, we have almost crossed 6 months of 2025. But as we progress deeper into 2025, we have to see whether geopolitical issues settle down, whether inflation reaches a target of 2% in many economies. Okay, if the central banks and the governments of those economies are able to mellow down or reduce the inflation and reduce the borrowing cost in their own countries for development and growth, and what is the kind of free trade agreements, what is the kind of alliances which are working between different nations in the world, so that they are somewhere circumventing around the US. Okay, like they're not, of course, not trying to not follow what he's saying, but they're also trying to find their own ways and means of not going behind US. Okay, so guys, you all don't need to take the screenshots for this presentation. I can share this presentation with the admin team, and it can be relayed to all of you. Do not worry about that. Okay. So yes, definitely a lot of policies from Donald Trump's desk. And this is one question I'm sure that will all come in your mind, that why do we need to care so much about what US is doing? The reason is, since the World War II, the World War II made US emerge as a victorious and as a superpower. Since then until date, what has happened is all your major international organizations, whether it's the United Nations, it's a WTO, it's a IMF, and many more to name, they all are from US. Okay, US has been the dominant partner, or rather, I would say the founder of these international organizations. Second reason why US, we need to bother so much about US is because of the dollar, which is an international currency across the globe. Third thing why we need to bother about US as an economy is whatever policies, like today US is connected in such a way in our lives, or rather US companies for that matter of fact. You take Amazon, you take Microsoft. I'll give you like the top 7 companies or even the top 10 companies. Out of the top 10 companies in the world, 9 are from US. Okay, or rather 8 are from US. One is from Saudi Arabia, that is Aramco, which is an energy based company. Second one is TSMC, it's a semiconductor or a chip manufacturing company from Taiwan. The other 8 top companies are from USA. Your Meta, your Google, Apple, Amazon, Microsoft, Visa, MasterCard, Adobe. These companies are all embedded in our lives to such an extent that we need to care whatever is coming from the US president's desk. Okay. Even though we might confine our markets to, or we might confine our trade to other economies and other nations, but majorly what happens is that whatever US does in terms of the policy, whatever kind of implementation they have, that is going to impact our lives. Okay, so that is why we need to focus on what's coming in from the Federal Reserve out there, what's coming in from the different companies from USA. Also, another thing that we recently saw was Donald Trump was advocating a lot of cryptocurrency. Okay, and we understand that cryptocurrency is very volatile. We understand that cryptocurrency does not have any real asset in place. But still, Donald Trump has been able to create that kind of demand. And also he's trying to do this so that, again, people would, even if they're ditching the dollar, people would ensure they are investing in Bitcoin or Ether, some of the top cryptocurrencies which are traded in the world. At least Bitcoin and Ether are. Okay, Ether or Ethereum, you can pronounce it in any way. So these are in demand. So somewhere or the other, US will kind of get the capital flows and the dollar will be in demand. It will not become a weaker currency. So this is also a reason where a cryptocurrency, okay, has being pushed by Donald Trump. Also, students, in case there are any questions, you can keep on typing in the chat box. I will answer it as and when I take a pause. Okay. Now, what are the investment themes? I think this is a question which will all come in your mind, and some can easily guess it. That definitely some of the investment themes, and in fact, I would like to add one here, is defense. Even if by 2026, if we are able to settle down all the geopolitical issues, despite that, I'm sure countries are going to invest heavily in defense. Okay, like in India, we have seen a growth of our own domestic companies setting up defense production, and now we are even able to export that. There has been a large chunk of allocation towards the defense manufacturing, and going ahead, other nations also will be largely investing in defense. Defense, aerospace, okay, will be two areas I think which will be a priority for many of the countries when you talk about even investment themes. Then comes your technology with your AI. But moving further to AI is also quantum computing. Okay, and this is the next big disruption which is right around the corner. Again, US, today I was seeing a chart that US is leading the world with 77 startups already in the quantum computing space. And you should read more about it. There is a report by World Economic Forum and Accenture on how quantum computing is important to detect cyber issues, cyber threats. It's important for cyber security. Also, at the same time, it helps us to analyze the market trends, the threats, and design customized investment portfolios. So this is the kind of technology that we'll be seeing in the coming years. That is the quantum computing, which will help us to design good investment portfolios, I think, which will be market resilient to a large extent. Okay, so that's another investment theme. Then growing concerns for sustainability and renewable energy. That is going to be another area which is going to attract a lot of heavy investment. Now the world is talking a lot about data centers. In fact, there are a lot of these digital real assets which are being invested into data centers. That's another investment theme which is coming up. Okay, and definitely when we are talking about the healthcare and we're talking about pharma. Okay, so this is another aspect which we will be focusing on in terms of the investment themes. All right, so just you can probably have a look at it, and you can even probably see that we have supply chain, we have m-commerce, I mean the FMCG. These all themes will definitely continue to be there, but in terms of the top themes, it will be defense. Okay, it's going to be aerospace, it's going to be artificial intelligence, quantum computing, it's going to be sustainability. Okay, all of this, and even healthcare and health tech. So these can be the themes not just for 2025, but even for 2026 and 27. Very, very futuristic. Also, you can see a lot of development is now happening in robotics once again. Okay, and that could also be an area which you could attract investment. Also, robo advisors or robo wealth managers are a trend of the future, which probably could be around the corner, as we can see that there is an aging population now in the entire world, not just in a few cities or countries, but the world is moving towards a declining population stage. We will definitely move towards more technology, more of robotics to fill or bridge this gap. So these could also be areas which you might look up for the purpose of investment. Now we have sectoral growth, which I have given here, and what you can look at in terms of the outlook, whether it can be bullish, that means it's incremental, it's increasing, a positive one, a resilient one, stable, and you need to be a little cautious. Okay. So you have technology and AI. So majorly here we have strong research and development happening in technology and AI. Have a strong key growth, a lot of investment coming in. CapEx is your capital expenditure. Like I said, data centers, that's your capital expenditure. Okay, so it's again a bullish trend. There's a lot of investment coming in on this frontier. Healthcare is positive because as the age is going, the stress is increasing. Health is definitely something which is getting impacted by the external factors. Okay, and that goes without saying that the first thing is you're going to rely on medication. So pharma companies, also we are unfortunately seeing a lot of increase in the cancer cases, a lot of increase in different kinds of viruses which are still going around the world in different countries. Despite the vaccines on the COVID virus or the coronavirus, there are many other viruses which keep on bouncing back and impacting certain countries and cities. So healthcare definitely will be one particular sector which will have a positive outlook. Okay, obesity is another concern which is coming up, and sugar intake. So these are all products which are eventually leading to healthcare concerns. So primarily pharma healthcare would have a positive outlook, and even the aging population, as I mentioned earlier. Defense, and now also shifting focus from gold to silver and copper. So, because of the geopolitical issues, a lot of countries, including China, have been heavily importing copper because copper is the essential ingredient or raw material for your defense products. Also, we have seen the shift from petrol and diesel and crude oil to electric vehicles. And with the electric vehicles usage increasing, we again have a high demand for copper. That's another area where copper is in high demand. Gold has been obviously touching higher highs because of the geopolitical issues. So, in geopolitical issues, you will see financial markets collapsing. But at the same time, we've seen gold becoming valuable, and that always happen. Again, there is no reasoning that because the equity market is down, the gold is rising up. That's behind that is countries will start investing in gold. Okay, countries will start investing in gold because at any point in time, if they fear there is a war or any kind of crisis, they can use gold as as a collateral to get money. Okay, they can use gold because see, even when Russia-Ukraine war started and US government at that time, Joe Biden was the president, and he had frozen all the dollars, okay, that Russia had. So in that case, what could Russia do? Russia could only use the gold that they had. Okay, so this is the reason why gold is always a good investment because be whatever kind of situation, gold will be in demand because it becomes an excellent collateral whenever there is such a contingent or like a very unsettling thing happening. Okay. Also, as a part of your portfolio, generally it is recommended that 10% of gold should be kept in the portfolio. It also helps to take care the rising inflation. Okay, it also helps to take care the rise in or I would say the deteriorating money value. So gold helps to take care of that. Okay, but I don't know. There are a lot of reports which are saying that gold has already touched its peak, and because gold is becoming expensive, it might lose demand, and you might even see a reversal in the gold trend. It might even start falling down. So it's even better to diversify between metals like silver and between copper, okay, rather than focusing only on gold. So far gold has given excellent returns, but that may not be the scenario in future. All right. Then coming to financial services. So financial services, yes, the backbone of any economy, particularly it is the backbone of emerging economy, but there are a lot of risk factors, particularly credit risk, risk from other nations and countries, which keep on impacting the financial sector, the bank. Okay. So we should be a little cautious, and we should be careful while investing. But otherwise, for driving economic growth and with the progress and advancement in the fintech space, where we have moved, or we are moving from app based transactions, which we used to do on our phones and our apps. Now we are moving to smart glasses. Okay, we are moving to scanning our eyes, we are moving to scanning our palms. China has already started doing that. We do not even need our phones. Okay, some countries are having wearables, like you have a watch, you have a bracelet, you have a ring, instead of having the normal debit or credit cards. So this is also the kind of growth which is there, and probably this would see a stable, kind of incline as we progress into 2026, 2027, because fintech is definitely here to stay. People do not compromise on FMCG, come what may. We brush our teeth every day, we have a bath every day, we eat our food every day. So FMCG will always be in demand. Popular strategy by Mr. Warren Buffett is a blue whale strategy, where you need to include FMCG products in your portfolio, and that makes it a defensive strategy, because that will protect your portfolio from any kind of decline or downside. Then we have IT and pharma. So IT and pharma is again witnessing different kinds of ups and downs. Pharma, again, as I said, will be in demand, but IT will have a lot of disruption with new technologies coming in, with movement from AI to quantum to robotics. So you need to be a little cautious around these sectors. So this is sector-wise outlook given to you, and you can keep on tracking that which are the top 3 companies in each sectors which would be on your watch list and which you want to invest into. So some predictions from India and the world. So obviously with India, because they've been able to control the inflation, I've taken this because not just that we are hailing from India, but one thing is being done currently is the control on the inflation, because for quite some time the interest rate was high and it was not possible to reduce the inflation. But now the central bank has tried to reduce the inflation, and they are subsequently reducing the interest rates, because of which there is increased liquidity in the domestic market. There is growth in domestic market. There is also a lot of influx of foreign investment coming in through the foreign direct investment, where we even have companies like Tesla, which have opened up showrooms. Tesla, Apple, all of them have opened their retail stores in India because of the growing demand. So this is one thing which, probably we can see that is a little unusual at this point in time from the rest of the world. But I think India and Japan are 2 economies which are currently following a very different growth trajectory. Japan, on the other hand, never had inflation. Okay, it was a different case study altogether. There's a very interesting video which I will probably share with you the link towards the end of this session. The Japan always had deflation. They only studied inflation in their economics textbook. Okay, they never had inflation, not even at 2%. So say like if something would cost say $1, like ice cream would cost say $1, it costed $1 for 30 years. The price did not increase, the price did not go up. Can you beat that? But once the Russia-Ukraine war started post 2022, that's when we saw that the inflation kicked in because of the rising crude oil prices, and that's when Japan's economy started turning in a different direction. Because some amount of inflation is required. Why is it required? It is required to provide better wages, salaries to people, higher profits to companies, and even a higher inflow and outflow of money in the economy. So a 2% inflation is generally considered to be a healthy inflation. But as I said, for past 30 years, like you can say 2022 and prior to that, we primarily in Japan saw a continuous deflation. There was no inflation at all. Okay. But now even the financial markets in Japan are growing. In fact, because of deflation, there were no opportunities in Japan to invest and make money. Even though Japanese companies like Mitsubishi, Toyota, Haier, all of these names you've heard, right? And many more Japanese companies. These companies have presence across the globe. These companies have been doing so well, but despite that, there was no growth in the financial markets, And eventually Japan became one, or Japanese investors, institutional investors, became one of the investors which would always invest in the US treasuries, in the US government instruments called as the US treasury. Okay, so this was another outlook from Japan, and from India, more from the Asian markets. Now, what kind of strategies can we devise? Okay, so we know the sectors, we know the areas, we know the countries who are doing well. Now, what are the different kinds of investment strategies? So, one investment strategy that definitely works is dividing across different market capitalizations, not putting all your money in large cap companies unless you are older in age. Okay, like somebody who might be nearing retirement, for them we do suggest parking their money in the large cap companies. But for the others, where there is scope to take risk, where there's an opportunity for growth maybe to the extent of 30% in 1 year or even higher, that is your mid cap, the mid range, and the small cap companies. These companies have a lot of potential to grow. These companies have a good demand for their products. They have good potential to expand in the overseas nations, and therefore we need to diversify across the three market capitalizations. Okay, that's one. You also would diversify across different sectors, but you cannot invest in every sector. So it's important that you only choose 4 to 5 sectors and park your money there. Maybe 2 companies in each sector. That is something that you could look at. Not over diversifying, not over fragmenting your investment. Fragmenting means, okay, let me put like $10,000. No, like put like a big chunk of money so it will grow and multiply faster. Okay, focusing on domestic sectors, domestic growth, looking into the opportunities to invest at lower prices. Even when markets are falling, you should not panic. That is an opportunity to invest your money. That is an opportunity to buy at lower valuations, to buy cheap. And you should always look to buy cheap and sell at a higher price. That's how you maximize your profit. Okay, so never ever fear when the market goes down. Okay, always look to buy cheap and sell at an expensive price. Also, you could focus on certain sectors which are driving the consumption at this point in time, focusing on certain themes, like I said, defense. Okay, it could be AI, it could be robotics. So you might look at these funds, mutual funds per se, which is diversifying your money into these different companies in a particular sector and a particular theme. So these are some of the investment opportunities which we need to look at and outline for the coming year. I hope this is clear. Any questions, please put them in the chat box. Now, what are the risks and challenges? So, guys, risk can be divided into 2 categories. Ones which we can control, which are to a certain extent called unsystematic risk. The ones which I cannot control, okay, like geopolitical risk of failure of a particular economy, like an economy going into recession, okay, any other economic and political risk which cannot be controlled at all. Those are the systematic risks. And these systematic risk factors bring about the decline in the financial markets, bring about a very high risk. Okay, so you need to identify that whether there are risk factors which can be controlled to a certain extent, like you have the credit risk. Okay, there are certain risk factors which you can control, and there are certain risk factors which you cannot control. So here you have tariff escalations, trade disputes, which obviously we cannot control. We can, as a government, see what our country is doing to reduce the impact of tariffs, but over and above that, we really cannot manage it much. So it becomes a systematic risk, which will bring about impact on the volatility. Then we have the crude oil prices going up because of the geopolitical issues or any other such issue coming up, or scarcity of resources. Like even when China was attacking Taiwan because of the Taiwan semiconductor manufacturing unit to be captured, that could impact the chip manufacturing and the chip supply in the entire world. Okay, so these kind of things are beyond control. These are all systematic risk. Okay, you have talent scarcity. As I said, human capital also is getting damaged and deteriorated because of geopolitical issues. And this could have a very long-term impact. An aging population will have a long-term impact. We are reaching a median age in the world, which is close to 35 to 40, which is not good. The working population should be between 25 to 28, but we are reaching a median age of 35 to 40, which cannot be good for economies to grow and develop. And then we are seeing a lot of overvaluation, a lot of high pricing when it comes to the equities, and people might not have the money to invest in the equities, majorly because of people will not be able to invest in equities, majorly because of your increasing borrowing cost. Okay, so these are some of the risk and challenges which we have faced. Okay, these are some of the predictions that we are seeing. That is the Sensex and Nifty. You can see that is from the Indian markets. Then we have the S&P 500. So we don't see much of the growth in the US markets. We will see definitely a lot of backfiring probably coming in and happening with the policies of Donald Trump and the de-dollarization. Also, with the US markets not growing, it is going to impact the other economies also in the rest of the world. Okay. So some growth coming in from the emerging markets like India, but no growth majorly from the US market. So US market might just see a 4 to 7% of a growth, but other markets could see like a 16% or a 15% growth as well. Okay. Now, some of the insights which we have taken from the top broking companies like, say, Morgan Stanley. So, Morgan Stanley experts say that AI and energy will reshape investment priorities. India is on the upside. Global investors may still underestimate a rally which might be coming into India. And Mirai Asset says that small cap valuations still look attractive, that investing in small cap companies would still be advisable, looking at the kind of growth you might have in the near future. So, what's the minimum time investment that you would look at for investing in equity market? Can you tell me in the chat box what will be the minimum time horizon that you will look at? Will you look at 2 years? Would you look at 5 years? Would you look at 1 year? What is the minimum time horizon that you need to look at? Yes, everyone. The minimum time horizon that we might look at would be, okay, 5 years. Minimum should be at least 3 years, nothing less than 3 years. Okay, that should be the minimum time, because in 3 years, if you withdraw in 1 year, you're not going to make any substantial, even see your money doubling up. Okay, so that's the mark of a good investment, that in 3 years, you might really see your money doubling up. So basically, 2025 has opened up a lot of new avenues when it comes to investing in defense-oriented sectors, aerospace engineering, okay, investing in sectors which could be related to IT and even sustainable energy. Like now, we are also introducing electricity-based futures, renewable energy futures and options. So that's also coming up on the derivative side. And also, we might get into more volatile and liquid investments when it comes to gold, like an electronic gold receipt. Okay, that is what is coming up, which is becoming affordable for people to invest. At the same time, it's more liquid and it will be more in demand. Okay, so most importantly, we should not panic. We should ensure that we are tracking the market, but we are not running behind the timing. We are buying at cheaper valuations as far as possible, but we do not keep on holding on to cash just because we won't think there is another correction around the corner. So a market correction is obviously a downfall, but whenever you see any correction coming in, whenever you see any kind of downfall coming in, please take advantage of that and keep on investing. And remember that you need to invest for at least 3 to 5 years. That's the kind of minimum time horizon that we have. Okay. So now if you have any questions, I would ask all of you to put them in the chat box. Likewise, I would also like to show you a video by Julius Baer, one of the leading wealth management firms, on a small insight into the market outlook. And then I can show you the Japanese case study as well. That's very, very interesting.
The idea that opportunities in the US are unique has gone, creating demand for alternative geographies.
Europe is well positioned for growth with low inflation, attractive fiscal stimulus, and room for further monetary policy easing. In equities, massive defence and infrastructure spending coming out of Germany will not just benefit Central Europe, but will also likely have positive knock-on effects for various sectors and countries. We favour financials and infrastructure, but also German small caps and Swiss mid-caps. When it comes to fixed income, we prefer quality investment bonds with moderate duration. And that is also true globally. When it comes to fixed income in emerging markets, though, especially when considering Latin America, we prefer higher quality hard currency corporate debt. In Asia, we see various attractive areas. Japan remains our favourite region for equities outside Europe. And in China, we prefer dividend and domestic demand stocks. But let's be clear, US stocks remain part of a well-diversified portfolio. But investors should focus on select investments that you just can't get anywhere else. AI is still a big topic, but look beyond the Magnificent Seven companies. US Treasuries used to be safe haven territory for fixed income investors, but this has changed dramatically. Given increased US debt, we see better opportunities in Germany and Switzerland.
The most important thing to do is not to jump ship, but stay invested. Diversification and strategic asset allocation are key to navigating the challenges ahead.
Okay, so as rightly mentioned in this video as well, talking about bond and investing in fixed income securities for a moderate duration, again 3 to 5 years, could be a better way to diversify your portfolio, where you keep on getting the fixed returns, where you keep on getting the fixed interest, and your money is stable. But again, there are a lot of opportunities to invest in equities, which should be unleashed. So all in all, your portfolio needs to be balanced with majorly your equity. And if you want like a formula, if you want me to give you a formula, like, okay, how much percentage should I put in equity? It should be 100 minus your age. So your equity investment should be, I'm writing in the chat box as well, each one's equity investment should be 100 minus their age. That's the kind of allocation we need to make in equity for 3 to 5 years. Okay, then remaining amount can go into metals, remaining amount can go into real estate, and even into bonds and treasuries, right? Now, this is the interesting video that we have about Japan, and as rightly mentioned in this video as well, that Japan's becoming a lucrative despite the aging population, despite the disadvantages that Japan has in terms of demographic. It is still becoming one of the lucrative destinations for investment.
Imagine a place where everything money related is frozen in time for almost 3 decades. Your salary doesn't budge, the price of your unagi bowl doesn't change, and the interest rate on your home mortgage is closer to 0.
Well, that was the reality here in Japan. We were used to the price of everything staying pretty much the same.
But it wasn't always like this. Since the end of World War II, Japan has been ground zero for some of the biggest experiments in economics. Older Japanese like Tomiko, a pensioner, and Suetaka, who runs a real estate agency, have experienced a roller coaster of changes throughout their lives. Now, Japan's central bank has decided it's time to end its latest experiment and exit negative interest rates. For the first time since 2007, the Bank of Japan, or the BOJ, raised rates.
YCC gone, the end of negative rates as well.
So how did Japan decide to manage its economy so differently from the rest of the world? And how is this massive shift going to disrupt day-to-day lives across the country?
Japan was a country which had negative interest rates. So what you mean by negative interest rates is when I park my money in the bank account, I need to make a payment to keep my money there. And when I am borrowing, I will get it at like 0.01% or maybe 0.02%. That's like even less than a percent of interest. That was the kind of situation in Japan for almost 30 years. They ensured that the returns or the interest on the bonds would not be higher. Okay, the bond returns would remain the same. They called it as a yield control curve. Okay, and because of the deflationary scenario in Japan, these things, I mean, it was easy to control and put in place these aspects. We could not do it in any other country. Majorly, other countries like US had zero interest rates where you could borrow at a 1 or 2% and you would not pay anything to just keep your money out there. But other countries did not have negative interest rates at all.
Japanese growth hasn't always been this stagnant. At one point, the economy was growing so fast that it looked like it was about to overtake the US as the world's biggest. Taro Kimura covers the Japanese economy for Bloomberg Economics. Before, he used to work at the BOJ, so here he is with a mini history lesson.
After the post-war devastation, Japan achieved something called economic miracle from the 1960s to early 1970s. That growth was led by a huge domestic demand because the middle-class households were expanding. In the late 1980s, Japan's economy actually accounted for about 10% of world's total economy.
楽しかったよね。私たちの時にはそんなに困らなかったんですよね。結構お給料も良かったし、ボーナスも良かったので。
それがずっと続くと思ってたわけです。紬の業者はビールで足を洗って歩きよったと言われるぐらいえらい景気が良かったわけですね。
At the time, many were flush with cash and reckless spending was the norm. By the end of the 1980s, the stock market was on the up and up, hitting record highs.
What was crazier was the real estate price. For example, the land price of Tokyo's Imperial Palace was said to be equivalent to the price of the state of California.
Then the bust came. In the first of its shock moves, the BOJ sharply raised interest rates in 1989, trying to curb speculation and rein in inflation. The government also introduced measures to cool the property sector.
Nikkei stock price index fell to half of its peak value, and real estate prices also plunged that led to a long-term downturn.
そういうバブルの時代、その当時勝った人たちは一旦バブルが弾けた時にはすぐ倒産の受け目にあったわけですね。バブルは所詮弾けるんです。いつかはですね。
Authorities had tried to pump the brakes, but instead they sent the economy to a screeching halt.
People in Japan didn't experience wage growth and inflation for about 3 decades. That means one generation for people. I myself, growing up in Japan, learned the concept of inflation from macroeconomic textbook. Living in the world in no inflation make people attach a certain product with a certain price.
物も上がってないけど給料も上がってないがねというのは気づいて、よその国と比較した時にこんなにも取り残されてしまったということですよね。
A small amount of inflation can help drive economic growth by keeping money moving around. Most economies target relatively mild inflation of about 2%. But as you can see from the yellow, Japan's inflation stayed below that for a long time. As things got worse, the Bank of Japan followed the typical playbook for central banks, lowering interest rates. You can see the Fed, for example, slashed rates to cope with the fallout from the 2008 financial crisis. But the BOJ, for more than 20 years, kept at it with its almost flat line, but it didn't help lift the country out of deflation. In 2013, the BOJ decided to do something drastic again. It introduced the quantitative and qualitative easing policy, an unconventional move where they basically print a lot of cash and pump it into the market by aggressively buying Japanese government bonds. It was successful at first, but Japan faced deflation again a couple years later, so the BOJ went back to its box of tricks. In 2016, it adopted negative rates, a move that divided economists. The main goal was to deter saving and also punish banks that hoarded cash, but that didn't really work either. In response, the BOJ invented something called yield curve control.
Yield curve control is an attempt that the BOJ controls not only short-term but also the long-term rates, so that the businesses and households don't have to worry about too much fluctuation in interest rates.
It could keep interest rates low by threatening to buy bonds without always having to actually buy them. That still didn't solve everything. Companies couldn't find enough profitable ways to invest their money in Japan. Many ended up looking abroad for better returns, so much so that Japan became the biggest foreign holder of US Treasury debt, overtaking China. Suddenly, in 2022, all of that changed. Japan finally hit its 2% inflation target. The problem was what prompted it. First, it was higher energy costs due to the Ukraine war, and second, a weaker yen.
The Bank of Japan continued easy monetary policy to stimulate the economy and even inflation. However, the other major central banks hiked rates in order to fight inflation.
Eventually, it was external forces that pushed Japan toward ending its experiments. In other words, it was not the sort of inflation that Japan wanted because it wasn't coming from consumers spending more. Wages stayed low, even as inflation hit 4.3% in January 2023, which was the fastest in decades. But it still caused the yen to weaken, boosting profits at companies like Sony and Toyota, which sell products abroad. That finally brought about some signs of change.
The business leaders who used to be reluctant to raise compensations in the fear of having a lot of fixed costs now started to become open to raise wages.
The main labor unions secured the biggest wage increases in 30 years. So finally, on March 19, 2024, the BOJ took a big step.
The Bank of Japan has ended negative interest rates 17 years since the last hike.
They're scrapping the yield curve control, and they're also going to essentially pare back their purchase of ETFs.
Raising the interest rate from negative 0.1% to a range of 0 to 0.1% doesn't seem like much, but it does put Japan back in line with other economies. We asked at the top that if Japan's negative rates experiment ends, what now? Well, here are some of the changes we can expect to see. First, mortgages will get more expensive for the first time in decades, and interest payments on the government's more than $8 trillion of debt, which is about twice the size of the country's economy, will increase. The same thing will happen to companies. It could also propel the yen higher. That means your trips to Japan could get more expensive, and Japanese exports would take a hit too. On the flip side, it can also make investing in Japan more lucrative. Plus, cheaper fuel and food imports are good news for Japanese consumers.
Okay, so guys, this was the short video about Japan's experiment and how Japan always faced a deflation. I hope you found this session informative. And now I would like to hand over the session to Renu for the conclusion. And in case you all have any questions, I'll be there for the next 2 minutes so we can take it up by putting them in the chat box.
Okay, thank you, Dr. Sadaf. And I think there are a few questions in the chat box. The first question being asked by Mr. Tabogo, now, why is gold always a good investment?
Yeah, so as I mentioned, that definitely 10% of your portfolio should be allocated towards gold, but do not over concentrate and try to include even silver and copper. These are also emerging metals which are in demand with the sectors that I explained to you. I think also there's a question asked by him about how important is strategic management to an organization. So strategic management is very critical because they are strategizing, they are building their capabilities with the new technologies and the new disruptions that are coming in. And when I'm looking forward to invest in these companies, I would always want to see that, how Apple is coming up with the next innovation. Maybe they're coming up with the Apple glasses, or Apple has the first watch, which is like a complete sustainable product. Okay. So we will also see what companies are doing from an investment perspective so that we feel that the companies are always on top of the curve. So strategic management, corporate strategy is of prime importance. How companies ensure that they have the highest return on equity, and they're also managing their customers, they're also giving them a good experience. Okay, so all of this comes under strategic management, which is very, very critical. And you can also get this from the annual reports of the company. You can read about how management's outlook is, and you can analyze their corporate strategy.
Thank you, Dr. Sadaf. So if you have any other questions, please go ahead. You can unmute and ask as well. Or else you can put the question in the chat box. So in the meantime, I have put a Google form in the chat, for your valuable feedbacks about the webinar. I hope all of you have really benefited out of this webinar. So before we conclude, is there any questions? So I think there are no more questions. Thank you, Dr. Sadaf, for your time, as well as giving us a very wonderful insight into the investment options. I think it was really helpful for everyone, giving a very comprehensive idea about where to invest and how much to invest as well. So before we come to an end of our webinar, I would like to introduce our learners to a program, a course, which is called the MBA in Finance, which is very much very quite related to what Dr. Sadaf had the webinar today. The program has been delivered by the Spanish university called UCAM. And to know more about the program also, we do have a launching session on 31st of this month where you can join. So please fill in the Google form there for that as well. So thank you everyone for attending this webinar, and we look forward for your valuable feedback. And also thank you, Dr. Sadaf.
Thank you so much, everybody. Thank you.